Navigating the world of tax audits can feel like you're trying to solve a giant puzzle, right? But today, we're going to hand you the map. We're going to laser focus on one of the most critical and, honestly, one of the most confusing parts of the Indian tax audit report, Clause 12 of Form 3CD. Whether you're running a business or you're the CA handling the books, getting this part right is absolutely essential.
So you're probably asking, does this even apply to me? If you're a business owner or a professional in India, that question is everything. It determines if you need to gear up for an audit or if you can breathe a little easier. So let's figure that out right now.
Okay, so here's our game plan. We'll kick things off with who actually needs a tax audit. Then, we're going to unpack this key idea called presumptive income. From there, we'll dive right into the heart of it all, how to report everything correctly under Clause 12. And of course, we'll cover the serious penalties for getting it wrong and wrap it all up with a simple checklist to keep you on track. First things first, let's talk about the mandatory tax audit itself. The whole requirement for this is laid out in Section 44AB of the Income Tax Act, and it's really the foundation for understanding what you need to do. The easiest way to think about it is like a special checkup for your business's finances, and it has to be done by a chartered accountant. The whole point isn't to catch you out, but to make sure your financial records are on the level and that you're reporting your income and deductions correctly, all according to tax law. Now, this is where it gets really interesting because it shows how the government is pushing for a digital economy. The standard limit for an audit is a turnover of 1 crore. But, and this is a big but, if you run a business that's mostly digital, where your cash transactions are 5% or less, that limit gets a massive boost, all the way up to 10 crore. It's a huge incentive to ditch the cash. Okay, but what if you're a professional, like a doctor, lawyer, or consultant? For you, this is the magic number, 50 lakh rupees. The threshold is different because professional income is all about gross receipts, not sales. If you cross that 50 lakh line in a financial year, then bingo, you're officially on the hook for a tax audit. Now, here's a twist. Even if you're flying under those audit limits, you might still need one. It all depends on how you calculate your income. This brings us to a really important concept called presumptive income. Think of it as a shortcut that's directly tied to our main topic, Clause 12. Basically, the whole idea behind presumptive taxation is to make your life easier. Instead of getting bogged down with super detailed accounting, you can just declare your income as a set percentage of your turnover. It's kind of like the tax code's express lane, but you still have to follow the rules of the road. These are the heavy hitters when it comes to presumptive schemes. If your business fits into one of these categories and you decide to use this method, you're telling the tax man you're using a formula to calculate your profit. And that decision, that choice to go presumptive, is exactly what Clause 12 of the tax audit report is all about capturing. Okay, let's roll up our sleeves. This is the real meat and potatoes of it all. How do you actually get this right on the Form 3C? Let's get super practical and look at what Clause 12 is asking for. Now, the question itself seems super simple, right? It's just a yes or no. But wow, that simple answer has huge implications. If your P&L account has income that you calculated using one of those presumptive schemes, your auditor absolutely must report it here. Getting this wrong can cause a world of trouble. So if you check yes, you can't just stop there. Your auditor has to lay out all the details, just like you see here. They need to specify which section of the law, the exact amount of income, and, this is critical, how you got to that number. Was it based on turnover, gross receipts? You have to be totally transparent. And this quote from the ICAI's own guidance note, it really nails it. This isn't just about culling numbers out of thin air. The auditor needs to use their professional judgment, and it all has to be backed by solid evidence. Think about it. If you have one office but 2 different business streams, how do you split the rent fairly? The auditor has to be convinced that your method is reasonable and, most importantly, defensible. It all boils down to good record keeping. All right, now for the part nobody likes to talk about but everybody needs to hear. What happens if you're supposed to get a tax audit and you just don't? Let's talk about the consequences. Look, the law doesn't mess around here. Failing to get your accounts audited and filed on time isn't a minor slip. It automatically triggers a specific penalty under Section 271B. This isn't one of those things with wiggle room. It's a hard rule, and it comes with some serious financial teeth. So how bad is the damage?
Well, they calculate it as 0.5% of your total turnover for the year. For a business doing, say, 2 crores in turnover, you're looking at a penalty of 1 lakh rupees. But thankfully, there is a silver lining. There's a cap on the penalty, so it's the lesser of the two amounts.
Yeah, 150,000 rupees. Just let that sink in for a second. It's a big number, and it's definitely a penalty designed to make you pay attention. It is a very expensive mistake to make.
So you might be thinking, is that it? Miss the deadline, pay the fine, end of story? Well, not exactly. The law does leave a tiny escape hatch, but I gotta tell you, it's a very narrow one.
You can get out of the penalty, but only if you can prove you had a reasonable cause for not getting the audit done. And I have to be clear, we're not talking about my dog ate my homework kind of excuses. The bar is incredibly high. We're talking about serious, unavoidable situations like your auditor quitting right before the deadline or a fire that destroys your account books. Just being busy or saying you didn't know, yeah, that's not going to fly.
Okay, let's bring it all home. To make sure none of this slips through the cracks, here's a super simple, actionable checklist for you. This is your roadmap to staying compliant and avoiding that last-minute panic. It really just boils down to these 4 things. 1, keep a constant eye on your turnover. Don't get surprised at the end of the year. 2, know if you're using presumptive income schemes. 3, if you are, make darn sure your auditor has all the info to report it correctly under Clause 12. And finally, number 4, get those deadlines in your calendar and treat them like they're gold. And that really is the last and maybe most important question I want to leave you with. Because at the end of the day, when it comes to an audit, any audit, good intentions just aren't enough. The only thing that truly has your back is solid proof, meticulous records, and strong documentation. That's your best defense for a smooth and, most importantly, a penalty-free journey with the tax department.